afternoon. Welcome to BNN Bloomberg's special coverage of the federal government's fall economic update. I'm John Ehrlichman. Nice to have you with us. In the next few minutes, we are expecting the Finance Minister, Chrystia Freeland, to share a fresh outlook with Canadians. A boom in our commodity sector has helped to improve the country's finances over the course of the year, and we'll likely see that reflected in the new estimate for this year's deficit. But that boost could likely be short-lived as Canada's economy is quickly cooling down. And for Freeland, any commitments to new spending will likely get a thumbs down from Bay Street, considering the ongoing fight against inflation, a big problem that is impacting all Canadians. If the Bank of Canada is raising interest rates to curb high prices, can the Finance Minister afford to be out of sync with our central bank? Well, coming up, we will explore that theme and bring you all of the breaking news. Our BNN Bloomberg reporters are ready to go. We'll get insight from the former parliamentary budget officer and the head of the Canadian Federation of Independent Business. And for the next hour, we'll be joined by two special contributors. Anne McClellan is the former Deputy Prime Minister and a longtime board member in this country. She's also a senior advisor at Bennett Jones. And Sean Speer served as an economic advisor to former Prime Minister Stephen Harper. Sean is a fellow with the Public Policy Forum and the editor-at-large for The Hub. Welcome to both of you. And I want to start with you as we get ready for this update and your expectations for today.
Affordability seems to be the watchword. She can't ignore that. But at the same time, she cannot fuel inflation. So you've seen this government do some targeted things already. I think she'll probably have a handful of targeted measures to try and help those most in need. But she's also got to be, I think, pivoting to that longer term economic growth strategy. She's got to be sending some signals to investors out there in terms of where this government is going and who they're going to be there to help in terms of long-term economic growth.
All right, Sean Speer, let me bring you into the conversation. I have a sense I know what fiscally you're going to be talking about today. You know, the idea of anything new in terms of spending. How would you feel about that?
Yeah, let me just pick up what Anne said. I think the government needs to be very careful not to make the job of the Bank of Canada any more difficult in terms of bringing inflation under control. But inflation is having another kind of impact on Ottawa's budget, John, and that is on the revenue side. Just a couple of weeks ago, the Parliamentary Budget Office produced its own economic and fiscal outlook. And what's fascinating is in the PBO's analysis, revenue is projected to grow by $160 billion over the next 6 years, and about half of that the PBO attributes to stronger than expected inflation. And so, you know, the government may indeed claim that it's making progress on the deficit, and try to present itself as more concerned about so-called fiscal discipline. But I suspect what the opposition parties, markets, and ordinary Canadians will be looking at is the relative work that inflation's doing to actually improve Ottawa's bottom line.
And whenever we cover, whether it's the budget or an economic update, there are some very real numbers attached to these storylines. Sometimes, though, it feels a little bit more like political theater, but this feels different. Just the sense that right now, given where the global economy is, and heck, we just saw a great example in the UK as we keep tabs on the House of Commons and the Finance Minister's unveiling of this economic update. This feels different, Anne, just in terms of the need to have coordination between central banks that are boosting interest rates to fight inflation, and governments that play a role in that inflationary story.
Oh, absolutely. And of course, there's no question that governments around the world, including our own, contributed to inflation because they pumped an awful lot of money during COVID into the Canadian economy, into people's pockets. And I don't think anybody would disagree that it was needed for quite considerable time. But we also have to acknowledge that, in fact, that did help fuel inflation. And now the Bank of Canada, whether they were too slow dealing with it, as were other banks around the world, I think that's ridiculous to spend any time talking about that now. We have to deal with the reality of the situation, and that's what the Bank of Canada is doing. But yeah, Chrystia Freeland has signaled that this is a different moment, if you like, in time. She's signaling now that there probably will be a short and hopefully not particularly damaging recession.
Well, we've got a lot to unpack, Sean, and sit tight. Up next, we'll bring you analysis of the government's economic update and the closing bells on Bay Street and Wall Street. Stay with us. We'll be right back. All right, the bells are ringing on Bay Street and Wall Street as we wrap up the Thursday trading session, coming to an end as we prepare for the government's fiscal update and our expert panel waiting in the wings. But first, we want to walk you through how the major markets ended in North America on this Thursday. And remember, the market is still digesting what we learned from the U.S. Federal Reserve yesterday, which is that interest rates are going to keep going up and there's no pushback or pivot that is planned right now. Yesterday, that resulted in a 2.5% slide for the S&P 500, and it resumed its selling ways today, down about 1%. The NASDAQ in particular, some of those tech-related stocks, and there are ongoing concerns about the road ahead for a lot of technology companies. More companies unveiling layoffs today, down closer to 2%. Our TSX faring a little bit better, however, in a choppy session overall. The benchmark in Toronto down 35 points or 0.2%. Healthcare and energy stocks helping to offset some weakness in the materials, real estate, and utilities group. All right, now back to our special coverage of the government's fiscal update. Okay, we are just moments away from getting that update in Ottawa on the economic update. Now, one of the big things we were expecting was that we would see a sizable reduction in the deficit because there have been some optimistic things happening for the economy this year, namely commodities and booming prices there that have certainly helped portions of the economy. But the bigger question is, where are we going as interest rates rise and inflation is still a mighty challenge? And the balancing act that the finance minister has to engage given the uncertainty right now. Let's bring in our expert panel once again. Anne McClellan joining us, the former Deputy Prime Minister, and Sean Speer, who previously served as an advisor to the former Prime Minister, Stephen Harper. Sean, let me pick it up where we last spoke and this balancing act that the finance minister has to engage in.
Yeah, you mentioned, John, before the break that this fall economic statement is being tabled against the backdrop of
Sean,
the...
I'm sorry to interrupt you, but we are just getting those details right now, so let's take it away. Just reading some of the headlines. I'm going to start with the deficit picture, Anne and Sean. As we expected, in part because of the commodities boom, we are seeing a more narrow deficit for the year. Now, the government sees a deficit for the 2022-2023 year of $36 billion. Now, that might sound sizable, but remember, going back to the budget, the estimate was a lot closer to $53 billion. So a lot of the economists on Bay Street were projecting that, maybe we'd see a $20 to $30 billion improvement. Part of that, obviously, is tied to the commodities picture improving. But given the fact that you have this uncertainty for the economy looming, the federal government is also putting in place a roadmap for what happens in worst-case scenarios for the economy. A hard landing, for example, and they've unveiled a few different scenarios. One which could see the Bank of Canada raise interest rates to 4.5% by the first quarter of 2024. Now, you consider the fact that we have seen rates rise by 3.5% or percentage points since March. It's a reminder of the challenges that we are seeing ahead. And then one other thing that has been developing over the course of today, the reports about Canada possibly imposing a tax on stock buybacks for corporations. The idea there to ensure that there is more focus on spending here at home. Well, indeed, we are seeing some details here from the finance minister of the plan for the Liberal government to impose a 2% tax on stock buybacks starting January 1st, 2024. Now, our own David George Kosh has been covering all the details. He's fresh out of the lockup, and he joins us with a full recap. David, take it away.
John, that improved fiscal economic outlook has narrowed that deficit down from the previously announced $52 $38.8 billion down to $36.4 billion. That deficit will improve to $30.6 billion in the fiscal 2024. The government does anticipate $6.1 billion in new spending in the current fiscal year. That will slightly go down to $5 billion in the next fiscal year. And more importantly, the budget will return to surplus in the fiscal 2028 with $4.5 billion of surplus expected to happen by then. But again, that is about 5 fiscal years away. Let's go into some of the details on some of the new spending and tax credits that the government has announced in this fall economic statement. $2.8 billion over 5 years to get rid of student loan interest for good, forever. So that's definitely good news for students that still have to pay some of their loans down. That corporate share buyback tax that you just announced, that's 2%. That will raise $2.1 billion beginning in 2024. That's over a 5-year period. They also unveiled a $4 billion new workers' benefit advance payment plan. Furthermore, the government does anticipate to move on lowering credit card transaction fees for small businesses. They will anticipate the industry looking to negotiate that down lower, as well as new tax credits for clean tech, hydrogen investments, as well as new spending on various science, immigration, and youth job initiatives as well, John.
New spending, David. This seems to be the key couple of words here, because we knew there would be a quote-unquote windfall, the idea that the government could afford to take some of the money that has come in as a result of, in part, the commodity story this year and perhaps spend it. But should they spend it given the environment? So just to recap some of those numbers you were sharing with us, you see a much improved deficit picture, but I guess nearly $13.5 billion in new spending commitments earmarked here. So the Trudeau government taking some of that windfall, actually a sizable amount of that, and planning to spend it, although I guess putting out the idea that the budget is on track for balance in the years ahead. Yeah, certainly. And these spending initiatives appear to be quite modest, and from a political spectrum appear to tilt quite on the left, especially the corporate share buyback tax, as well as the student loan interest payments, which will be, again, eliminated forever. That certainly caught my eye as well. Announcing a 2% tax on share buybacks. That's right. And this is going to be very controversial already. When we asked the head of Canaccord Genuity today what he thinks about something like that, he said, stay out of our way. You know, let us focus on building our businesses as we see fit. But we want to get some more reaction. David, stay with us. We appreciate the update from David George Kosh, who was in the lockup. Joining us for some more perspective on this breaking news is the former parliamentary budget officer, Kevin Page. He is currently the president of the Institute of Fiscal Studies and Democracy at the University of Ottawa. Kevin, I think the biggest question specifically on the deficit picture, we were pretty clear that it was going to improve. We did not know whether or not this government would engage in new spending, just given the concerns that come from new spending in an inflationary environment. What's your reaction?
Yeah, I think you got it right, John. There is spending. I mean, the government, as you noted, that there was a windfall from this new outlook. I think over 6 years, it totals about $80 billion. There were already pre-announced measures before we got to the fall economic statement today, probably in the neighborhood of $20 billion and over the 6 years. And there's about $30 billion, $31 billion worth of new measures in this fall economic statement. So I guess the government really couldn't help themselves. They wanted to kind of, with this different trajectory, a lower deficit trajectory than what we had in budget 2022. They wanted to spend some of it. Some of it's going, about a third of it's going to deal what we would call like affordability measures, as highlighted. Student, interest on the student loans, or stuff that we've already knew was going to happen. The doubling of the GST credit. The advance payments with respect to the worker income benefit. And then, I think the other third is business related. And part of that business related is the tax credit. It's the biggest component of it. There's like $8.5 billion worth of measures that are completely unannounced, which are part of that $30 billion over the next six years. So it's modest. And the deficit picture is much improved.
I think the biggest question from a lot of people in the business industry that I heard was, if you go that way at all, it really changes the messaging away from fiscal prudence at a time where, this isn't just a Canada story. We just saw what happened in the UK, where there were completely, huge tensions between monetary policy and those officials and government policy, they were clearly at odds, and it's hard to say ultimately where things go from here. But what is clear is that the government is forecasting for a few different scenarios for the economy. Now, they're forecasting what could end up being, a more mild recession, but they're also forecasting for, a so-called hard landing. If they're willing to go that far and acknowledge the fact that rates might have to continue to climb and we could see some tough times ahead for the economy, what do you think the justification for additional spending is at this time?
Yeah, I think probably 2 points, John. One is that I think they, as they're political people, just they see people that are hurting because of the high inflation, and trying to give breaks to students, try to give breaks to low-income people. They saw that as some modest help that would not be broadly deemed to be inflationary. I think on the other front of it, I think they realize, and this is often gets talked about in Bloomberg, that we're falling behind on investment and business investment. We have not recovered, since in the pre-COVID period. They realize that there's a bigger transition going on. And so, I think they want to do what they can to actually facilitate that transition to a higher investment environment. So, yeah, modest amount of measures, but it's still spending.
I guess the part that gets a little confusing to me just on business investment, I mean, just the idea of trying to influence corporations to not buy back their own stock, to invest in their businesses. Is that the kind of thing that you think ultimately encourages people to invest in their business?
Well, I think that they're hoping that it will. Whether it will turn out to be a significant measure remains to be seen. It's from a revenue generating perspective, John. It doesn't generate a lot of revenue. It's $2 billion over the 6 years. Maybe in the outer years, maybe as much as $500 million a year. So it's not going to fund any significant kind of program expansion. But yeah, I think there are other measures there that with respect to the tax credit on green tech. Something that they talked about in budget 2022, this kind of growth fund that they would seed and hope that would stimulate investment. I think it's a start. I think it's more of a signal in this update, John, and it's not a budget. That that they're letting people know that we're going to to facilitate transition. The government's going to work with the private sector to try to get more investment.
All right. Just a final one for you. And just to, as we're continuing to track this, Kevin, the finance minister had told reporters today that she's confident that she has struck the right approach here. Quote, "We know how important it is right now in this economic moment where we find ourselves for the federal government not to pour fuel on the flames of inflation." You talked about at the margins giving people who need that help a break with this update and this spending. I guess the challenge that a lot of people are having right now is when you give people money or additional money now, does that not actually fan the flames of inflation, which again hit all Canadians and in particular hit Canadians with the lowest incomes?
Yeah, I think that is, that is the concern. So I think we look at two things. One, we look at the size of the amount of new spending. Again, it's $30 billion over 6 years. And then we look at where that money is kind of going. And yes, it's going to low-income people and it's going to students for the most part. And then some of it is going, in terms to that investment tax credit. So I don't think, like, from the point of view of the challenge that we're facing with respect to inflation, trying to get that, the inflation rate down into the target range, the 1 to 3% range. I don't think this amount of measures, given the size of the economy, $2.8 trillion, it's going to make much difference to the inflationary numbers. It's, if there was more broad, universal kind of spending kind of programs, I think it would have, the reaction would have been probably more akin to the UK reaction. The markets would react quite negatively. I think we're talking about a deficit today, John, of 1.3 percentage points of GDP, about $35 billion. 2020. We were talking about a deficit of $330 billion, almost 15 percentage points of GDP. The trajectory in the deficit is the right trajectory.
All right. Really good to get your insight and analysis as always, Kevin. Thanks very much for joining us. Kevin Page, the former parliamentary budget officer and the CEO of the Institute of Fiscal Studies. Great to get his analysis. I want to bring back the senior advisor at Bennett Jones and the former Deputy Prime Minister, Anne McClellan, who's been listening in as well. Am I missing something here, Ann? I mean, at the end of the day, I get it. There was always that temptation to take some of this windfall and put it to work and to help people. But the elephant in the room for the longest time here was that we weren't talking about what governments had done over the last couple of years in terms of spending. And we weren't talking about it because we didn't know what COVID would end up being and where it would take us, and we needed to spend a lot of money. But since inflation is so hard to control right now, and we are staring in the face of a potential recession, how does the finance minister, how does the Trudeau government communicate a message around the idea that they are pushing fiscal prudence when they have added to the spending bill?
Look, I think I'm a former elected official. When you have as many people in this country hurting, food bank numbers in my province, Alberta, higher than the rest of the country. But those kinds of pressures, people being able to make the rent, keep a roof over their kids' houses, it would be one brave government that said, we are not going to at least respond to some of those needs in a targeted fashion, where the need is the greatest, where we think actually the impact, as you've just heard from the former parliamentary budget officer, where the impact on inflation is going to be minimal. Look, that to me, it was always about the balance. And you have to respond to some of the needs that people are facing out there. And at the same time, you try to do it, not only in a way that doesn't fuel inflation, but you start to look at the economic growth agenda. And that's one of the things that interests me the most today, in terms of, are we going to start to meet the Inflation Reduction Act measures that the Biden government put in place? Huge concern in this country, John, that we're going to bleed investment dollars to the U.S. Today, Chrystia Freeland started to deal with that. That is important in terms of economic growth, sustainable economic growth going forward, because it's about clean tech. It's about making sure that carbon capture and storage is treated in a way that will attract the investment necessary to hit our targets in 2050. It's about putting money on the table in one form or another, John, to ensure that we're investing in small modular reactors, that we're investing in hydrogen. So I think you see some of that. This is not a budget. But you see some of that, which is so important to the work that my colleague Lisa Raitt and I do in the Coalition for a Better Future.
Yeah. Sean Speer, you are back with us. I want to bring you back into the conversation. Can we be sure that these measures are not inflationary for a government that has done an awful lot of spending over the last few years? And can we be sure that when you announce a tax, albeit a small one, on corporate stock buybacks, that is something that helps investment in this country?
Yeah, I broadly agree with Ann. I think, the fact that inflation has had such a significant impact on government revenues on one hand made it pretty difficult on the other hand not for the government not to announce some targeted measures. It would look like in effect it was taking and not returning, particularly to those most vulnerable households. But I would just say, guys, I do think that, leading into the winter budget 2023, the big challenge for the government will be persuading markets and others that they can stick to this level of fiscal discipline, because, of course, this is a sea change from what we've seen from the Trudeau government, not just through the pandemic. Its first 5 years in office, pre-pandemic, average program spending grew on average by 6.5% per year. So I guess what I would say in a nutshell is this is a positive kind of down payment on a renewed commitment to fiscal discipline. And the real test will be the forthcoming budget, which will be tabled in a minority parliament, which will require new Democratic support to pass. Chrystia Freeland has a kind of difficult road ahead. And that's not even saying anything about the potential for a recession in 2023.
Which the government pretty much made clear is now its expectation going into next year, Sean. And obviously the rapidly rising interest rates that are creating a lot of complications for people who have debt. And there are a lot of people in this country that are carrying a big debt load. Should we not also clarify, Sean, that given the debt load of the federal government, that it too is going to have to be preparing for higher interest payments as interest rates rise? They are talking about this projected return to balance by 2028. Is that something you think is attainable?
I don't take a lot of credence in projections out to 2028, particularly in the world of uncertainty in which we find ourselves. But let me just dwell for a second on your point, because it's a terribly important one. For the past several years, debt interest costs for the government have been really low. $20 billion, $25 billion. According to its own estimates, they're close to doubling in the next couple of years. And that's a combination of the debt stock growing, of course, but also the interest rate that they're paying on the debt. That's going to start to crowd out spending on key priorities, some of the productive investments that Anne's raised. For the first time in a long time, debt interest costs for governments, not just the federal government, will become a meaningful expenditure that in a zero-sum world will mean less resources available for the things that people really care about.
All right. And I want to just bring you back in terms of, this is an opportunity for this government as well to get ready for, a story of growth. You've already alluded to some of those bigger picture, long-term issues that everybody is grappling with. And obviously this government in particular has focused on with the green transition. I'm seeing some reaction right now from the Canadian Federation of Independent Business, which is expressing some disappointment in this, describing auto as making their problem worse with significant hikes in EI and CPP premiums on January 1st, carbon taxes later in 2023. And I guess this is what sometimes feels like a great disconnect, right? The idea that we have these big long-term issues that I don't think anyone would disagree that we want to solve. But right now we're fresh out of a pandemic. We thought we might have the roaring 20s. And boy, for a lot of business owners in this country, many small business owners that, represent a huge chunk of our economy, there could be some frustration with the picture heading into next year. What do you think about that?
Look, the increases that you've just mentioned are not new. They're not in this economic statement. I think in a way that's old news. But having said that, I'm not unsympathetic to especially small and medium-sized business coming out of the pandemic and having to deal with disrupted supply chains, which in turn have driven the cost of doing business up for them. Employees, talent. Where's the talent of the future coming from? For small, medium-sized business, for big business in this country. I think Sean Fraser started to address that a couple of days ago in terms of the 500,000 new immigration number. I think what you see the government doing here is starting to put in place the framework around economic growth. Now, to your point, sure, short term, people are still struggling, and I think this isn't the budget. You're probably going to see the minister take a look and hear a lot from small and medium-sized business in the lead up to the next budget. But I think what's really important is thinking about the economic future. Where do we get the inclusive, sustainable economic growth of the future? And I think what you see is this government starting to hone in on some of the big pieces. More immigration, competing with the U.S. around clean tech and net zero measures for carbon capture, hydrogen, SMRs, clean tech more generally, biomanufacturing. I think you're starting to see where this government sees the future economic growth coming, and they will be working with the provinces and the private sector to see how that investment can shape up? Everybody agrees we're going to be in a worse position, John, 5 years from now, regardless of what's happening right now, unless we start to make the investments to ensure that economic growth going forward.
And
John, can I just jump in for 1 quick minute, just to build on some of the things Anne has said? If viewers do a Control F of this document and search for the word supply, it comes up a number of times, and this strikes me as a significant change from what we've seen from this government really since it took office. A government that was principally focused on the demand side of the economy through fiscal and monetary policy. I think the emphasis on supply, it reflects in part some of the work that Anne and the coalition have done to try to put a greater emphasis on the supply side of the economy and long-term economic growth. And I think it represents, at least in theory, a positive step. And the question, as I said earlier, going into the winter budget, is how the government starts to put meat on the bone behind this supply side idea. Just one final point in this regard. Some of that will involve a role for public investment, trying to catalyze new technologies, as Anne's outlined. But a bigger part, or at least as big part, will be unblocking the kind of regulatory morass across our country that stands in the way of private investment in energy, housing, and so on. Chrystia Freeland painted a picture of regulatory reform in a speech that she gave a couple of weeks ago in Washington, and it seems to me that'll be a big file moving forward. How much kind of political risk is the government prepared to undertake on the regulatory side to enable this kind of supply side agenda, which seems to be pointed to in this fall economic statement?
All helpful points, Sean and Anne, which, we'll continue to absorb all of that. It is complicated, though. Obviously, this is an economy, to Anne's point, that is going to benefit from immigration, and that will help the economy. But since housing is a key part of that story, and the affordability of housing was seen as one of these key initiatives, the situation we're in right now, with rising interest rates rapidly in the interim, as we are just unable to control inflation, has made affordability less and less so for Canadians. And then on the investment side, I'll just reiterate, folks, that the Trudeau government took these steps to level the corporate playing field with the United States with that 2% tax on stock buybacks. It's worth pointing out that is double the size of the 1% excise tax on repurchases that was signed into law by the U.S. President Joe Biden as part of the Inflation Reduction Act that was unveiled in August. We'll continue to watch the Bay Street reaction. Anne and Sean, I do want to bring in David George Kosh once again, who's been helping us to cover this developing story and all the information that the finance minister made available, which includes projections on the economic front heading into next year.
Yeah, especially on the downside. And this certainly caught my eye. We never necessarily saw a lot of modeling on the downside of things too much from the federal government anytime they put out a budget, or a mini budget, as this fall economic statement is often referred to. So in terms of a potential hard landing, the government has modeled what the economy will look like if that happens. Now, again, no one wants this to happen, but the government has projected that inflation is likely to remain stubbornly above 3% over the course of the next year and return to that 2% target by the end of 2024. That's that target, that 2% target, is what the Bank of Canada is mandated to have the Canadian economy sit at going forward. Now, the Bank of Canada would have to raise its interest rates from the current level of 3.75 to 4.5% by the first quarter, of 2024 to essentially make sure that they can draw inflation down to that 2% target. A mild, quote unquote, recession is seen to hit the Canadian economy in the first quarter of next year. Meanwhile, the economy is expected to contract if that recession does happen, according to the government's projections, by 1.6%. Relatively, that's lower than the 4.5% that the Canadian economy contracted in 2008 and 2009, John. Meanwhile, that also comes with $10 billion less in income tax revenue, an $80 U.S. Price of oil. The Canadian dollar will sit at around 73 cents, and the deficit will continue to climb to $49 billion in the fiscal 2023. That's $16 billion more that the government projects going forward.
Helpful projections. I'm still a bit confused, though. We hear the same kind of language from the Bank of Canada, which says it's time to pull back some money, raise interest rates, and this government, well, dancing around fiscal prudence, still doesn't seem to be quite in lockstep with the central bank. But that's not just a Canada story. We saw that play out in the UK recently.
Look, John, they did get a windfall in terms of revenue over the course of the past 6 to 8 months. So they are trying to use some of that powder that they've kept to push their agenda forward. There's obviously, again, that student loan interest. That's nearly $3 billion in new spending that they're going to have to initiate, as well as the tax credit for clean tech. I mean, spurring economic growth in that aspect. But also, I mean, that 2% tax on corporate share buybacks, that will raise about $2 billion. But again, we'll see how popular that is, and we'll see if there's any changes to that particular piece of legislation ahead of that 2024 launch.
Well, we'll get some reaction from the small business community as our coverage here of this fall economic update continues. David, thank you very much. And our thanks to Ann and to Sean. We will see them after the break. Stay with us for our continuing coverage. All right, welcome back to BNN Bloomberg. I'm John Ehrlichman. We are continuing to coverage the fall economic statement from the Trudeau government. And one of the big headlines, and we knew it would likely be this headline, is that because of some of the benefits we've seen, particularly from the commodities industry this year in this country, that the size of this deficit will be notably smaller than previously thought. But there will be some spending from that windfall from this government. It seems like a balancing act for the Trudeau government between assisting Canadians who are dealing with skyrocketing prices versus trying to avoid fanning the flames of inflation, which I don't have to tell you have resulted in what sometimes feels like an unprecedented rate of interest rate increases that aren't just felt by individual Canadians, but small businesses as well. And joining us now is Dan Kelly, he's the president and CEO of the Canadian Federation of Independent Business. And Dan, you're our first business reaction voice here. What is your reaction?
Well, look, there were a couple of positive things in the fall economic statement, but overall, it was a real missed opportunity to help small businesses deal with the massive inflationary and cost pressures that they face every day. Governments haven't taken a break from the tax hikes. There still is a CPP hike and an employment insurance hike on January 1st, carbon tax increases in April, and no relief for small businesses, at least none very quickly, that will be able to help small firms dealing with the cost hikes that they're facing right now.
I guess the tricky part of all of this, since I've been sort of talking about some of the other areas of spending, some of that short-term relief for businesses who truly need it right now, anything new always creates this pickle, doesn't it? Because, I mean, we're all sitting here, we're watching every meeting. The Bank of Canada keeps raising interest rates to fight inflation, and it does feel like the federal government has that opportunity to just stay on the sidelines with a lot of spending. Politically difficult, but whether it's talking about hard-hit Canadians or hard-hit businesses.
Well, look, there are ways that you don't have to get involved in taking off putting your foot on the gas of the spending side. You could actually put the foot on the brake of the tax hike side, freezing EI premiums, freezing Canada Pension Plan premiums, at least for a year until inflation is under control. I don't think that would have any major inflationary reaction and would provide some much needed relief. Remember, every single Canadian worker is going to see their paycheck go down on January 1st, significantly down on a monthly basis, with hundreds of dollars in new payroll taxes that they're going to face. Employers are going to face the same thing. There is some good news. The government did announce a pathway, finally, to a balanced budget, and that we receive quite well. That small firms know that today's deficits are tomorrow's tax hikes, so it is good news that we finally got a pathway there.
Okay, I want to talk about a couple of bigger picture things that the government talked about tied to business, and maybe not something that a small business thinks about each and every minute of the day. But certainly on Bay Street, we were wondering what exactly would happen with this tax on stock buybacks. And, you know, some people are saying, well, look, this is a reaction to what's happening in the United States. But at the end of the day, the plan is to see a 2% tax on stock buybacks. And as well, we are seeing about $6.5 billion in tax credits for clean technologies over 5 years. So some of the messaging here is sort of going toe-to-toe with what we just saw out of the United States. Nevertheless, I spoke to the head of Canaccord Genuity earlier today, And he basically said, Ottawa, please stay out of our way. Let us run our operations. Let us invest in our businesses and hire people without having to think about these various parameters that are coming from Ottawa. For the individual business owner, how do they feel about all this?
Well, look, matching some of the U.S. incentives obviously will be important for people, particularly manufacturing, medium-sized businesses that supply the auto industry. They can help in ensuring that Canadian businesses don't lose out and see more pressure to relocate to the United States. The stock buyback tax, that one is a little bit above the small business pay grade.
Yeah.
One of the other big stories I can tell you, though, and a positive one, is that Ottawa is finally getting serious about lowering credit card processing fees. This has been a big deal for small businesses, small merchants. So much more of our spend is on credit cards these days as Canadians. That's put big pressure on the small businesses who have to pay 1.5–2.5% of the sale to the credit card companies and the banks. Ottawa has talked about some immediate action to try to get those costs down. They've been promising this for years, so I'm hoping that we're going to see some quick help on that front in the months ahead.
What is your general view, and certainly some of this the CFIB thinks about, some of it larger corporations are thinking about, but the business climate in Canada, and we were talking with Sean Speer and Anne McClellan about this earlier, because this kind of becomes a table setter for whatever the budget in the spring ends up looking like. Yeah. And, they'll probably talk about growth and a roadmap for more investment in this country, but I think there have been a lot of people that have been frustrated with the lack of investment into this country.
Look, for the last number of years, growing this Canadian economy has been item number 50, 60 on the government's priority list, and it's really felt that way. Those policy choices that have been made or not made over the last number of years are catching up with us. We're losing competitiveness. We're losing that fast. Canadian small firms are getting restless. And, of course, there's a lot of damage over the course of the past 2 years that has not been healed. So we need more of this kind of thing. There is a little bit more economic focus and a pathway to balanced budgets in this economic statement. Let's hope that in the spring 2023 budget, we'll see a lot more focus on the Canadian economy, a lot less simply on social policy. While important, that isn't the only issue of concern as we move into some rougher economic waters. Getting the economy and growing the pie is pretty darn important.
Before I let you go, maybe you could walk us through the day in the life of a small business in this country right now, with inflation as it is and rates going up. And I keep going back to all of this because we have to sit here and listen to what the Bank of Canada is telling us about the outlook for the economy and this need to raise interest rates to avoid a worst case scenario for inflation. And today there was some reference to fiscal prudence, but it was not the overarching theme that came out of this economic update. So for the average small business in this country that is having to navigate higher interest rates and the inflationary reality, what would you say?
Look, the story I hear every day is that the small businesses' sales are not yet back to pre-pandemic levels. In fact, our small business dashboard shows only about half of Canada's small businesses are back to normal sales. They're now facing a mountain of COVID-related debt, on average $144,000 in fresh debt just to get past the last couple of years. They're facing cost increases on every line of their budget, a crippling shortage of labor. So even when they see business opportunity, they're not able to capitalize on it. There are some measures in the fall economic statement that will help on a few of those fronts, but overall a missed opportunity, especially when we think about the tax hikes that are planned in only a few short months.
All right. Dan, nice to get your perspective, your reaction. We appreciate your time. Dan Kelly of the CFIB joining us. By the way, some of the things that Dan was alluding to, we have full details on our website, bnnbloomberg.ca. We've got a full write-up right now, very specifically on that new cost of living support, the measures that were just announced on the website. We have more on the specifics of the deficit picture, what it looks like, more on that corporate stock buyback tax plan for 2024, and more. So be sure, as we're continuing to cover this story, check out bnnbloomberg.ca. I do want to bring back our panel, Anne McClellan back with us, the former Deputy Prime Minister, and Sean Speer, who of course was an advisor to the former Prime Minister Stephen Harper. And I'll come back to you. And, I think the comments that Dan Kelly was just making there about the challenges that businesses are dealing with every day are also the challenges that a lot of Canadians are dealing with every day. And I'm not sure that this government was in an easy spot today. And then you got, people like me that are immediately going to sort of jump on whatever we hear here. But in terms of the message, is it crystal clear? Do they get an A in terms of what they've sent out there? Is there a clear message that we're going to try to help Canadians who are dealing with uncertainty and inflation and tougher times without fanning the flames of inflation?
Well, that's certainly the message that the minister and the government are trying to send. And look, we said at the beginning, this was always going to be a question of balance. And I think that's what she has tried to achieve today. As I say, you could not, when you look at, yes, an improved deficit position for 22-23, money, a windfall, let's call them, windfall revenues in the Treasury. I don't think with the food bank lines expanding, with the holiday season coming, that this government could conceivably not have tried to have done something to help the most in need. Is it enough if you're a New Democrat? Probably, I guess I can predict no. But they had to strike a balance. They had to do something for those who are the most in need. And I always come back to this point, you've got to keep your eye on the future. You've got to, even in these tough times, think about setting the economy up for future growth and future success. And she had to strike that balance today. And there are a number of things in this document that actually speak to that future growth agenda. And it was tough. Is the message clear? I think the message is probably not as clear as either those in need today would like, or the industry, business, big or small, in terms of where the government wants to put the big bets going forward in terms of our future economic growth. Is it perfect? No. But I think she's tried to strike a balance, and we've got some clues in terms of where she sees economic growth and where she wants to go with it in the future.
And your point there
John,
about windfall, Sean, I guess this is the times we're living in when we talk about a windfall, and you still got a projected deficit of $36 billion. But c'est la vie. And Sean, to Anne's point about the NDP, I'm just looking at a tweet in the last couple of minutes from Jagmeet Singh, the leader of the NDP. He said, quote, "Families are struggling to put food on the table and heat their homes, while rich CEOs make $1 million a day in extra profits. Today, instead of making rich CEOs pay what they owe, Justin Trudeau let families down who are facing record inflation." And we knew there would be political rhetoric on both sides, but I think this inflation issue, I mean, forget about politics in Canada. This is a issue that every country around the world is grappling with right now.
Yeah, let me just say two things as quick as I can. The first is on the inflation issue. I was talking to David Frum a couple of days ago. He said to me, even in a recession, when we have 8, 9, 10% unemployment, most people's economic life goes on mostly unchanged. The political economy challenge with inflation is if you have 6, 7, 8% inflation, everybody feels it, and it's kryptonite for governments. And so I agree with Anne that irrespective of whether the new measures announced in this fall economic statement are good public policy, there was a kind of political context here that can't be underestimated. The second point, though, just quickly, John, you talked with Anne a bit about political messaging and narrative and so on. I would just draw attention to your business investor viewers to dueling speeches tomorrow from Chrystia Freeland and Conservative leader Pierre Poilievre. The two are expected in major addresses to set out their own respective views on the role of government in the economy, how to generate the type of growth that Anne's talking about. It seems to me we are going to have a kind of starker competing perspectives on the economy, on growth, on the role of government than we've seen for some time. And I think today's document on behalf of the Trudeau government is a bit of a down payment in that ongoing debate that we're going to see play out between now and 2025. And I will just say one final thing. I kind of agree with Anne that that the message out of the government is somewhat muddled. for better or for worse, it is not muddled from Pierre Poilievre. He's got a message that has resonated through the Conservative leadership, and I suspect one that he'll bring forward tomorrow and ongoing, and it'll be up to the government to match them.
Oh, and since I mentioned the tweet from the NDP leader, I'll mention the tweet from the Conservative leader, to your point there, who said the cost of Trudeau's government is driving up the cost of living. I want to give our Andy Bell a chance to jump in here as well, because he's been looking at something we've already talked a little bit about, but this sort of these tax credits for so-called clean technologies, and it's an area you've actually been exploring for months, really.
And this was widely expected that the government would make an announcement here after, in the States, they brought in that widespread portfolio of supports for clean energy. Yeah. So the Canadian government was expected to respond to keep this country's clean technology or clean energy sector competitive. They had talked about this initially in budget 2022, but they are moving ahead with these 30% tax credits. They're costing them, as John told you, at more than $6 billion. It'll be a wide range, though, of so-called clean technologies here. Nuclear, small nuclear reactors, hydro, where it involves run-of-river or small hydro, because, of course, there have been questions raised of the impact of giant hydroelectric schemes. And interestingly, though, John, I'm not sure, I may have missed it if you touched on this, but they are specifying the actual labor conditions, the actual pay and stuff that should be involved if you're to get the full 30% credit. It has to include paying prevailing wages based on the local labor market, and also ensuring apprenticeship training opportunities are being created. So, as in America, they're specifying the kind of jobs that should be created here.
You often talk to a lot of people who are investing in the hydrogen economy as well, and there is a clarification point there?
Yeah, that's right. So they're not, as far as I can see, giving any kind of a dollar here, but they are a dollar figure for the cost, but they are moving ahead with support for hydrogen. They say there's going to be an investment tax credit in Alberta. Major spending plans are in place to try to make Canada into a hub for hydrogen exports.
I know we have to move on, but just real quickly, was there an opportunity here as well for the government to just talk more about our natural resources industry, which in this world of geopolitical uncertainty, a lot of people have been looking at Canada as a place, is that a missed opportunity?
Well, it's a tough one for the government because on the one hand, of course, they're committed to a carbon price. They're committed to a world in which we cut back on the use of oil and gas. I haven't read the full statement yet, but I haven't seen...
it's a lot of reading.
No, that's right.
You can do it tonight.
I didn't see an espousing of the natural resource industry in that sense in a way that would be welcome, for example, in Alberta.
Okay, Andy, very helpful breakdown. Thank you very
John.
much. Commodities host Andy Bell joining us. I do want to get to Perrin Beatties, the President and CEO of the Canadian Chamber of Commerce, who's been kind enough to join us as well with his reaction. Nice to see you again, Perrin. What is your reaction?
Great to be here, thanks. Well, it's based on what I've been able to see so far, it's largely a placeholder. There's nothing dramatic one way or the other here. No major tax increases across the board. Good news is that there's at least a path to a balanced budget down the road. But for the most part, I think we're waiting until the spring budget.
I wonder if that language around the path to a balanced budget is their way of indicating fiscal prudence. Is that what you're essentially saying?
I think that's what they're suggesting, that we're not going to be irresponsible, and that we recognize the fact that we can't spend our way back to prosperity, particularly if we're borrowing the money to do it with. But what I would have liked to have seen is a focus on growth. What's abundantly clear from the document itself, from things the minister has said, Bank of Canada and others, is we're either going to see a recession next year or it's going to be very close to a recession. Even without that, the projected growth for the foreseeable future is very anemic, and we're falling behind our competitors. We need to have a plan, a strategy that's coherent, that looks at all of the elements of growth and what needs to be done to attract investment into Canada and to create growth in this country.
Yeah, and presumably, they're planting a few seeds for whatever we see in the spring budget, and maybe more details on the longer-term growth map. The uniqueness of this economic update is that the issues that Canada is grappling with right now, outside of, finding new investment or any specific issues here at home, most countries are dealing with higher inflation. Most countries are dealing with interest rates rising at levels that feel unprecedented to this generation of Canadians. And you mentioned that this was a placeholder, but there were a lot of people, especially on Bay Street, who said it's pretty simple. You either hold the line and very strongly signal fiscal prudence, or the message gets muddied. And because there was this ability to see an economy that was improving over the course of the year due to our commodities reliance as well, that there is some of that money that is now earmarked for some new spending. And the other reason I keep coming back to this is we literally just saw an example in the UK where there was chaos in the markets, which then bled into global markets because of what felt like a central bank and a government that were not on the same page. But it sounds like you think there is a little bit more alliance, at least just with the messaging we keep getting from the Bank of Canada and what the finance minister unveiled with us today.
Yep. The very worst thing would have been if the Bank of Canada had one foot on the brake and the government of Canada had one foot on the gas, and it just would have made no sense whatsoever. The Minister of Finance recognized that she can't insulate Canadians against the impact of inflation and of higher interest rates, and if she attempted to do so, it would simply drive inflation that much higher. It wouldn't make any sense.
All right, Perrin, really good to get your insight and analysis as always. We appreciate your time. Perrin Beatty is the President and CEO of the Canadian Chamber of Commerce. And I do want to bring back our panel for their final words on this economic update. Anne McClellan's been kind enough to join us through the hour, the former Deputy Prime Minister and a senior advisor at Bennett Jones, as well as Sean Speer, the former advisor on the economic side to former Prime Minister Stephen Harper. He's the editor-at-large of The Hub and the Public Policy Forum Fellow. Sean, I'll start with you this time, I guess, just in terms of your final thoughts of the messaging on this Thursday and the takeaways that everybody's going to be. He's laughing. He's chuckling. All right, take it away.
I think the biggest test this government is going to face ongoing is its credibility on spending. You know, we've talked a bit today, John, that the main reason the deficit has improved in this current year is because we've seen almost $30 billion in revenue upside, and then the government, as you've outlined a couple of times, turned around and spent upwards of $6 or $7 billion of that windfall. Come the budget, the question is, can the government hold the line, or is past as prologue? And we go back not just to the profligacy that we saw during the pandemic, which, as Anne said earlier, was broadly supported. It's the 5 years before then when average spending growth approached something like 6.5%. That's not going to cut it in a world in which financial markets are scrutinizing fiscal policy more closely than they've had in a long period of time. And so I think, as Perrin said earlier, I think the key message out of this fall economic statement is stay tuned.
Okay. Anne McClellan?
I think I generally agree. I think the minister is signaling and trying to get us conditioned for harder times ahead. I think she has some promising signals in this document from my perspective and the coalition's perspective in relation to focusing on longer term, inclusive, sustainable economic growth, because unless we focus, and I know it's hard when you've got people who are barely able to feed their children, but you have to do two things at once. You have to deal with those short-term pressures, but you have to be planning and working with the private sector in the provinces to put in place the conditions for that long-term economic growth that we all want. There are signals there in this document that she gets it. She understands how important that is. And I'm with Sean. Stay tuned.
And just going back to what Perrin Beatty was just saying, he seemed to be craving more on the growth story for the long term. Do we get more of those details, you think, in the spring budget?
Well, yeah, and she signaled details in relation to things like the hydrogen tax credit. Yeah. That was discussed in the 22 budget, but they're going to be out consulting. So there's no question that she will have more detail in relation to elements of the growth agenda in budget 2022. Budget 23.
I know. Well, we're throwing out all sorts of numbers these days. My head is constantly spinning. Sean, just coming back, because this government was willing to throw out a few different economic scenarios, I guess in, let's say the worst case scenario, I don't want to be negative here, but I work at BNN Bloomberg and I hear what all the pundits are talking about all the time here. Does that throw some of this out the window? I mean, just the idea that you were accounting for a possible sizable recession. But what happens in a sizable recession, just in terms of a lot of this planning?
Yeah, let me just say two things quick. First of all, I think it's to the government's credit that they've set out these scenarios in a period of such uncertainty. I think there's benefit to err on the side of transparency. So good on the government for giving us a bit of a band in terms of its fiscal projections going forward. But secondly, I think you're exactly right. This document projects a surplus by 27, 28. I think you'll hear members of the government hold that up as a sign of fiscal discipline. But as you say, John, all bets are off. If we enter 2023, 2024 in a deep recession, most of the numbers in today's budget won't be all that useful as a guidepost for the economic and fiscal health of our country.
Okay. Sean, and thank you. Great to have you both back with us as we continue to make sense of the fiscal picture in this country. I wish you well. We look forward to continuing the conversation in the days and weeks ahead. Anne McClellan, the former Deputy Prime Minister, joining us, as well as Sean Speer, former economic advisor to former Prime Minister Stephen Harper. And as we wrap things up, beyond thanking Anne and thanking Sean, do want to thank all of our guests in this past hour. Dan Kelly was with us, Perrin Beatty, just a couple examples, as well as Kevin Page, the former parliamentary budget officer. Great perspective. A big thanks to our entire BNN Bloomberg team for all of their hard work behind the scenes. And we have continuing coverage, as we mentioned, on our website, bnnbloomberg.ca. A lot of great stories that dive deeper into all these important developments. And of course, I want to thank you for watching every day, and specifically this special coverage of the Fall Economic Update. Thanks very much. Good night.